Good morning and welcome to our webinar on the implications of the Consolidated Appropriations Act of 2021, otherwise known as the Act. Last year we had the CARES Act, today we just have the Act. I'm your host, Rick DeLugash, a partner with Waldron Rand, Certified Public Accountants, and I'm joined today by members of my team and the law firm of Partridge, Hahn. Let me first tell you a little bit about the two firms and the team presenting today. First of all, Waldron Rand, I always like to say this, is the oldest accounting firm in the nation. Next year, we're going to be 110 years old. I've only been here about 80. We provide accounting, tax, and auditing services to individuals and privately held businesses in a wide range of industries throughout the U.S. and globally. For my team today, I'm joined by one of my partners, Tom Barrett, as well as one of our business tax specialists, Adam Menlard. Our co-host today is the law firm of Partridge, Hahn. They are a regional business law and commercial litigation firm dedicated to providing excellence in legal services and business planning. The firm's attorneys act as counsel to privately and publicly held businesses and nonprofit institutions of all sizes, spanning a wide range of industries, very similar to ourselves. As part of the panel today, we have Jay Peabody, who's a partner and the firm's transactional practice chair. And we have of counsel tax attorney Russell Stein. The agenda today, I'm going to present, I have the easiest part. I'm just going to go over a few miscellaneous tax provisions that were included in the bill. Tom is going to be talking about the both the application for and the forgiveness of both the first PPP and the second draw PPP, which has now just come out. And the employee retention credit, which is a huge topic this year, is going to be covered by both Jay and Russell. Although the employee retention credit was around last year, it wasn't applicable if you took the PPP. So now that is a big area. A couple of housekeeping matters. We're going to try to keep this to an hour plus or minus. We'll have some questions along the way. Adam is going to be monitoring the questions that will only or should only come through the Q&A function. I do not believe we are using the chat function. So if you have any questions, please put in through the Q&A and Adam will be monitoring that. If it's something that he feels should be discussed about as we're talking about a topic, he'll interrupt. If it's something, maybe at the end, he'll save some questions at the end. All right, let me start with these miscellaneous tax provisions. Right. One of the big changes that was made was the deductibility of expenses that the first draw PP loans were used for. When Congress passed the CARES Act, they specifically said that if the loan is forgiven, it's tax-free, tax-exempt, whatever. The IRS came along few months later, and I believe July, and they issued a ruling and said, okay, we agree it's tax-free, but from our perspective, based on past case law, any expenses that you pay with tax-free money is non-deductible, effectively making it taxable. So if you had $1 million of forgiveness of income and you paid $1 million expenses, the income's not taxable, but the $1 million expenses is not deductible. And that was not what Congress intended, but they could not change it until they passed a new law, which is now, they did under the Act. And that basically says, in very clear terms to the IRS, they didn't exactly say that, but they meant that the loan, if it's forgiven, is tax-free, and any expenses that you pay with those funds is deductible. And not only that, for those tax nerds out there, it increases your basis in an asset and allows you to potentially deduct those losses. And the reason they want that is it creates losses potentially in that year. And under the CARES Act, it allowed you to carry back those losses to get refunds from prior year's taxes, 5 years back. So that was the whole idea, to create liquidity, one of the ways to create liquidity. So that now is clarified. So obviously the taxpayers benefit. Another big change is on residential real estate depreciation. All right, back in 2018, under the Tax Cuts and Jobs Act, I believe it is. I think we have a new law every year now. They liberalized a lot of the depreciation, particularly in the way of upfront bonus depreciation. But at the same time, they went after large corporations when they lowered the rate, to 21%. And they also said that, well, we're going to limit the amount of interest you can deduct. To basically, at that time, was 30% of earnings before depreciation and before interest. But the way they defined the law, it said for entities including tax shelters. Nobody knew what the definition of tax shelters. I had a webinar on this last year, but effectively it affects most real estate syndications where you have limited partners. Consequently, out of our 700 partnerships, probably 300 of them were affected by this. However, Congress knew because real estate's highly leveraged, it'd be an issue. So they gave you an out. They said, if you do not want to be limited by the interest, that's okay, but you have to use a different depreciation life, what we call a ABS life. For commercial property, it went from 39 to 40. You had to give up a little bonus depreciation, maybe. Not a big issue. Residential basically said, if you acquire the property in 18, from 1/1/18 after, you went from 27 to 30. Not a big deal. If you acquired it before 17, you went from 27.5 to 40 years. And you had to recalculate the depreciation going forward. And we've been working under that method for the last 2 years. Now they came along and said, well, we were wrong, that we're going to allow you, even if you acquire the property in 15 or 16 or whatever, it's always 30 years. And now they're allowing you to do this year in 20, a makeup for basically 18 and 19 depreciation, the difference between the 30-year and the 40-year, plus obviously 20, and take it all this year. You have to do a 15-page questionnaire, submit a bunch of calculations, pretty much automatic, but you got to go through what they require to change your accounting method. Anyway, it's a big benefit to generate a lot of depreciation in 2020 and be able maybe to carry it back to 15 because we still have that carryback available for this year. Another change, the meals and entertainment deduction. Entertainment, as you know, in 2018 became zero deductible. That is not changing. So golf, Red Sox tickets, etc., can't deduct any of it. Meals, they left at 50%, but in a way to help restaurants now, they're now saying it's 100% deductible for 2021 and 22. Keep in mind, it has to be a legitimate business lunch. It just can't be you're going out for lunch and you're going to write it off. It's a business lunch, 100% deductible for next 2 years, obviously not for 2020. So that 3 martini lunch is back in vogue. All right, and there was a lot of other extender provisions dealing with extending or making permanent certain expiring tax credits and other specialized deductions like a 3-year life on a racehorse for those of you who race horses. But there's probably 40 or so of those items, which I'm not going to go into. But at this point, now we get into the meat of this webinar, which is the PPP and the ERC. I'll let Tom actually start with the PPP.
Thanks, Rick. Go to the next slide. One thing you'll notice throughout the webinar, I just want to bring attention to also is that you'll notice the pictures from the slide previously of us. We all have less hair on the Waldron side, so 2020 obviously took a lot out of everybody. But all kidding aside, so I want to talk about the PPP loan, both the initial and second draw. So on the initial PPP loan, a lot of you are already aware, this was for businesses with 500 or fewer employees and 501c6 organizations. There were different metrics of how you came up with that, et cetera. That was a big deal on the initial. On the second draw, it's businesses with 300 or fewer. And we did get a lot of questions on what the measurement of that is. And at this point in time, the best information available is that it's at the time in which you apply. So if you had 500 people and then you had to drop down to 300 because your business was impacted due to COVID, you obviously are still able to apply. The big part of this on the second draw is that you have to have a quarter comparing 2020 to 2019 where you had a 25% or more reduction in gross receipts. That's a big thing. And one thing on that is if you're under $150,000, you will have to prove with some of the banks and what we're hearing on feedback wise, you'll have to prove that you had the reduction upon forgiveness, as opposed to if you're over 150,000 on your second draw, they're asking for proof up front. And what they're asking for is internal records to document this, basically an internal P&L. Another question that's come up is the basis of accounting. It's not clear. It's actually a gray area. So one of the things we've been telling clients is the most conservative way to go would obviously be to apply using whatever basis you do your tax returns on. That being said, there could be a circumstance where you had, say you're an accrual basis taxpayer, but you're basically you are on an accrual basis. You did not meet the test, but on a cash basis you did because collections were slow. That's kind of a gray area. That's something that we would want to talk to you about before applying, but it seems to be that would be something that you may still be able to qualify with on that basis since it's not definitively written. And additionally, if you undercalculated your round one loan due to changes in PPP guidance, you can also apply for a second draw loan. And also at the bottom here, we noted you don't have to have forgiveness on your initial draw to get a second draw. So that should not stop you. So the borrowing capacity. So the borrowing capacity is basically 2.5 months, the average monthly payroll cost for 2019 or 2020. So for a lot of clients, this really should be a carbon copy of what you had for your round one loan. The reason for that is because thinking about it logically for a second, if your gross receipts are down, if you meet the gross receipts test, there's a good chance you had less payroll in 2020 than you did in 2019. That may not be the case. I want to be clear on that. So you're definitely going to want to look at it. But for a lot of businesses that were down, most likely you may have cut headcount as well. And in that case, it should be pretty easy to apply because it should really just be a carbon copy redo. There was one bank that was speaking with a client, and when they went to apply for their second draw, it automatically populated the amounts from the first draw. So, that's just something to keep in mind. One change here is if your NAICS code starts with a 7.2, and for those businesses, that would be, if you're in the food service business, if you're a restaurant, if you're a bar, if you are a catering company, etc. Because of the, say that again.
Hospitality, hotels.
Hospitality, yeah. And the easiest way to look for this is to look on the tax return. It's in the top on the first page. You will basically qualify for 3.5 times your average monthly payroll costs, obviously because of the devastation to those particular industries. On the second draw loan, you're limited to the $2 million cap per entity with a $4 million cap as an affiliated group. So if you had a bunch of businesses and they all individually were under the 2 million, but combined they were greater than 2 million, they'd be greater than 2 and less than 4. On the initial draw, you were limited to a $10 million cap. So that's a big change on that. So as Rick mentioned, on all PPP loans, now we have the expenses that are forgivable, and also he mentioned on the taxation of that, which is great. But as far as the actual expenses themselves that are forgivable, our initial guidance that we received was that it was payroll costs, mortgage interest, rent, and utilities. The Bill has now expanded those, added additional costs, which includes, as they call it, covered operations expenditures. And there's some listed here. These are actually right out of the actual act, as opposed to getting into detail, because that sounds like very high level. It could be anything, but specifically your payroll processing, HR costs, etc. The big ones here, for example, covered property damage costs. So let's say you're on Boylston Street and somebody kicked in your windows during the riots. Those costs would also be includable in determining whether or not you have forgiveness. Yes, sir. Yeah.
This applies both to the first draw and the second draw, I assume. But what happens if you already filed your first one and maybe it wasn't all forgiven because you didn't have enough payroll? Is there a procedure to go back and say, hey, now somebody that did not file for the forgiveness gets to go back and use this, but I already filed under the old law? What do I do?
So at this point in time, there isn't actually something out there, although we are of the belief that there is guidance coming, because that really doesn't seem very fair. If you rushed, applied for forgiveness, and now you're stuck in a situation where you have a balance left, but under the new rules, you would have had it all forgiven. It's our belief that there's going to be something coming out very soon that will make that a lot easier for companies. So, be in touch with your bank, and in a lot of cases, you might be applying for another round of the loan. So, good question. So, additionally, another big one is covered worker protection expenditures. So, for example, say you had PPE. You had to go out and buy a bunch of PPE for your employees. Those costs are also now includable. Again, at the bottom, we have the note. It's still subject to the 60-40 split, which means that 60% is payroll related, 40% is now the mortgage interest, rent, utilities, and the rest of these things down below. Go to the next slide, please. If anybody's not on mute, you can please mute yourself. Okay, so the tax implications of the PPP loans, Rick started to mention this in the opening slide. This is obviously the big part of this from the PPP side that everybody was unclear on, and they made it very clear. So the forgiveness of the PPP loan is non-taxable income, which we already knew, but the big one is the third one now, which is the expenses are deductible, as Rick highlighted earlier. One thing that I do want to be clear on, that a lot of people may have missed, there are potential state tax implications. For example, I'm assuming, a large percentage of people on the webinar are in Massachusetts. On pass-through entities, Massachusetts is not allowing the deduction of those expenses. So if you have PPP loan forgiven and you are deducting those expenses for federal purposes, you're going to have a federal versus state tax difference on that. And then again, you're going to have an increase in basis, which allows for all the expenses to be deductible without, say, for example, if you were an S corporation, you could have run into a problem where you would have had a distribution in excess of basis. They eliminated that by putting in the basis increase. Next slide, please. Okay, so on all PPP loans, a selection of your covered period, the initial guidance, if you remember, was that it was 8 weeks. Well, that bill was written on March 27th, which seems like forever ago, when nobody thought we'd be here in the end of January. So then, of course, they came out with additional guidance that said 24 weeks, and now the act says it's anytime between 8 and 24 weeks, and that's on all PPP loans from the data disbursement. So in a lot of cases, people were having a hard time meeting the 8-week test because headcount remained down. Once it was expanded to 24 weeks, for most businesses, made it relatively easy to meet the test. One thing I was actually kind of spitballing with Rick before we got on here. Say, for example, you didn't apply for a PPP loan the first time around. Now you have the ability to apply for a round one, as well as potentially a round two, because you can't apply for a round two if you haven't applied for a round one. One thing you might want to consider is the timing between when you apply. And so you may potentially treat the loans differently. You may want to try to apply for the first one under 8 weeks and apply for the second one later. That's something that you'd want to think about or discuss with us. Okay, so the audit plan. This is really for borrowers, again, together with their affiliates who receive $2 million or more. So within 45 days, the SBA will present to the committees of the House and Senate, and that's 45 days from the end of the 24-week period. So obviously we're coming up on a date here where there's going to be a lot of these, because a lot of these loans, the first round PPP loans, they came out they were actually issued in April. They ran out their 24-week period in October, or whatever the case may be. So we're basically bumping up against this time period. So what this basically is saying is that if you have 2 million or more, your documentation is subject to review. And I think that people were under the assumption that if you were over 2 million, you automatically were getting audited. We're not really sure if that's actually going to be the case anymore. There's going to be so many of them, and I don't know if they're actually going to go through a full-fledged audit, or if they have the people to actually do that. There definitely will be audits. The extent of them, I don't know that it's necessarily going to be automatic, and it depends how many ongoing audits they have. But your documentation will definitely be reviewed by the SBA, but whether or not there's a full-on audit, I think that's kind of to be determined. You should proceed when you have 2 million or more as if you're going to be audited. Whether or not that actually happens, I guess we'll actually see. And for all PPP loans, they wanted to make things simpler. The reason for this is because, this put a huge stress on the banking system. Obviously, the second round is going to kind of put another stress on it. The reality is that they don't have the ability or the horsepower to go through all these applications, all the documentation. They realize that so many of these loans, under $150,000 to go through utility payments and all that kind of stuff was just a massive time suck. And so they've released a one-page form that basically includes the number of employees at the time of the loan application, the number of employees at the time of the forgiveness, so the covered period that you selected, and then you basically include the amount of the covered loan you spent on payroll costs, total loan value, and then the requested loan forgiveness amount. The whole point of this is that you do not, at the bottom as it indicates, you don't have to submit documentation with this. This is really just a one-page affidavit going to the SBA that you're saying that you unequivocally properly use the money, okay, and that you would like it forgiven. It makes it much simpler for everybody. Yeah. Right.
You go back a little bit on the 25% test reduction. When on the first CARES Act, when they came out with it, they had some loose language in there that said everybody qualifies if you need the money, and it's very subjective. In good faith, if you thought you needed the money, which nobody knew what was coming down the pipe with what was going on. So, the argument was everybody in good faith can say they think they're going to need the money. In some cases, you ended up not needing it, but no one knew. This time around, they wanted to take away that subjectivity of it and basically said, if you meet this test, which is a 25% reduction in any one quarter of 2020. So you could be down 25% in one quarter from 20 to 19, and then end up being up for the year, or the next quarter be up 30%. The way they wrote this law, it's clear, 25%, any one quarter, you meet the needs test, you can apply, even if you end up for the whole year as if you're not, you don't need it. But that's
Absolutely.
how they, I don't know why they did it that way. They should have sort of balanced it out, but nevertheless, they said any one quarter of your choosing. So it
Absolutely.
opens it up in a lot of cases where otherwise it would not have. So I just wanted to touch base on that. Go ahead.
Yep.
Yeah.
Absolutely.
If I can just jump in there, the application for the PPP2 loan still has that subjective certification in there that you need the money in order to, because of the economic conditions. So you even though you now have this objective test, the subjective is still in there. So it still shouldn't be viewed as free money, which a lot of people did view this as free money back in March.
Absolutely.
All right. Good point. Go ahead, Tom.
So the timing of the loan forgiveness and repayment, a borrower can submit a loan forgiveness application anytime on or before the maturity date of the loan. Okay, so the maturity date of the loan, just to be clear for people, because I think a lot of people, the big thing here, the big takeaway here is you have plenty of time. A lot of people, I think, were running around thinking they had to get these things in, by 12/31 or, by some period of time, or they were stressing about it. And, the big takeaway is let's just make sure that it's properly documented. And also, more importantly, for some people, which Jay and Russ will get into in a little bit, especially if you have ERC potential, you're going to want to look at that. But what it basically says is the maturity date is 2 years if the loan origination was prior to June 5th, and 5 years if it was on or after June 5th. And the repayment is deferred until the earlier of the 10 months from the end of the 24-week covered period. So for a lot of people, that's 10 months from October, or the SBA remitting funds for loan forgiveness to lender. So the big takeaway here is these loans don't mature for years. The repayment period doesn't start for most of these loans until August of 2021. You have plenty of time to get your forgiveness in. So that's a big key takeaway there. I'm going to hand it off to Jay at this point, but I think this is kind of a good overlap. This is exactly what I was just talking about, which is, the PPP versus the ERC, and, are they mutually exclusive? As I was just saying, this is why it's important to consider these things, and I'm going to hand it off to Jay, who's going to take us into the ERC portion.
Sure. Thanks, Tom, Rick, for having both Russell and I. I'm not sure if you saw there, I disappeared for a little bit on the Zoom. I lost connectivity. So clearly we've walked through this and I understand the presentation, so I don't think I missed anything new or different. But one of the major elements of the Consolidated Appropriations Act and the changes relative to PPP and the ERC, which is the federal payroll tax credit related to employee retention or loss of employment by an employer, is very different and very new. And this is the where I think probably your CPA and your lawyers probably will interface and have to figure out a strategy for proceeding in this area. So in the past, under the CARES Act, if you had taken a PPP loan, you were not eligible for the ERC. Under the Consolidated Appropriations Act, you can apply for both PPP2 and get the ERC as long as the qualifying wages are not the same. So where in the past there was this mutual exclusivity between the benefits of the program, at this point you actually can. And I think the issue that we're seeing is how the employees apply, what rules and guidance exists, so that the taxpayer, in this case the employer, can get the most benefit of both programs under the new act. So Russell's going to go into some detail on the rules. They are very nuanced. They are very detailed. I absolutely would suggest a couple of things as threshold matters. So if you haven't applied for PPP1 forgiveness, our recommendation is at this point to hold tight. You have time, and then we can hopefully, as advisors, whether it be tax and legal, help you decide how you want to proceed with that forgiveness. And then secondarily, if and when you are looking to take advantage of the PPP2, the intersect between the ERC and the PPP2 eligibility is something that needs to be done in a very thorough manner and with outside advisory. So if you can flip that slide, I think there's one more slide here. Sure. So as I mentioned, the big changes are that now the two programs are not mutually exclusive, which can lead to significant economic enhancements for that employer / taxpayer. One of the things I'd like to do before we get into the details of the act relative to ERC is maybe throw back to Rick and Tom. You know, if we are sitting in a position where we have a client and we are considering a prior year, either amended return or looking at the 2021 landscape, what is it from our perspective do you want from the client's side so that you can work through this analysis and get the most measurable and meaningful enhancement, you know, given the new landscape? So what does that look like from you guys?
I'll take my initial crack at that. First of all, I guess the first question that would come up is, number one is, do you go back and amend to what you're allowed to do in the 941s, or do you include it, which I think you're also allowed to do, in the first quarter of 2021? I think our recommendation, unless you really need the cash, I don't like the idea with the IRS being as backlogged as they are of throwing in amended returns on a 941. I'm just not so sure they're going to get processed that quick. So to me, you know, even though we're allowed to go retroactively back to 2020 and claim the ERC if you're eligible and come up with a calculation, to me, I would probably say include that in the first quarter of your 941, because it'd be, I think that my own opinion, would probably get processed a little bit quicker. That's number one. Number two is, I mean, I think what you need to look at, because there's a big interplay here, is you need to schedule out your employees by quarter. Then you got to figure out, you know, how much salary you actually use for the forgiveness on the PPP, because again, you can't double dip. However, it's my understanding, and you guys come wrong here, that the guidance right now, although it's gray, says you have to, or you should, use the ERC, the wages for the ERC credit first, and then you have the wages that are eligible for the forgiveness that are still within that 24-week period. So there's a lot of calculations you have to go through. I think the starting point is summarize your payroll by quarter, and then you have to start doing a lot of gyrations, factoring in that 24-week period, you know, whether you're eligible. It's not an easy calculation. There's very little guidance right now on it. I would assume it should be coming out, but it's definitely an area that is open for interpretation. And the one thing I think, Tom, you and I were talking, the payroll companies do not know anything. They will take a number that you give them that said, I'm eligible for this credit. They will put it on the return online, whatever it is, I have no idea. But they will not tell you whether you calculate it right or wrong. So you have to make your best effort to calculate it and then tell the payroll company, this is the credit.
That's right. They're going to rely on us for the calculation and the guidance for sure.
And quite frankly, the guidance we got from the payroll companies on the initial PPP and on the forgiveness, we were seeing reports come out of the system that they said they developed this report that you can just file with the bank for the forgiveness. First of all, every payroll company did it different. And I don't know of one, including some of the major ones, I won't give their names, that had it right. So do not accept it. You have to make sure it makes sense.
I think
Yeah.
and I think the reality is that there is time. So being hasty doesn't make good sense. So to sort of hit pause, see where you are relative to the fact that the law has not only changed, but changed to the benefit of the taxpayer employer, and then to be very strategic about the interplay. So I think with that, we're going to let Russell go down into the weeds a little bit, and we will I think hear from him about the intricacies of the treatment of the various elements as it relates to both 2020 and 2021.
Thanks, Jay. Just to touch base on the time issue and when to do the PPP loan forgiveness and the ERC. One caveat to that is if a company is undergoing or is contemplating either purchasing another company or selling their own company, then timing does become an issue. Because with PPP loans and mergers and acquisitions, there are some strict rules that you have to consider. So if you are looking into that, you should consult your advisors and see what those rules are and how you can work with them. So on the employee retention credit, despite the legislation being about 5,600 pages, there's really very little guidance out there. The IRS does have about 94 frequently asked questions on their website, but they caveat it with two items. One, it does not take into account the December legislation. So all this act has not updated their frequently asked questions yet. And two, equally importantly, the IRS says you can't rely on these questions. They're going to give you advice, but if they come audit you, you can't rely on the advice that is on these frequently asked questions. So what that says is there's a lot of gray areas in the employee retention credit, and we're going to go into some of these gray areas as well. But there are a lot of areas that you're going to need to talk to your accountants, talk to your lawyers about to see what your situation is and how it would best fit into one of the rules that we're about to talk about. Like all other tax matters, this credit is heavily reliant on definitions, and some of these definitions are broad and create some uncertainty as to whether it applies to a specific situation. So in general, the credit is a refundable federal payroll credit. You actually can withhold taxes from the employees, and instead of paying the employer portion of that payroll tax, you can keep that cash if you meet the requirements. So it can be a way for you to generate more cash flow for the company instead of paying that cash to the IRS. Do not stop withholding from your employees the payroll portion of the taxes. So this credit does not mean you can just stop withholding. We would not recommend you doing that. The credit's claimed by companies on the quarterly tax return, but the credit is based on the number of employees, or how you calculate the credit is based on the number of employees has. There's no limit to the amount of employees a company can have, but depending on how many employees the company has is how you calculate the credit. So for 2020, which is the first ERC credit, the credit is equal to up to 50% of $10,000 of qualified wages. So in effect, for the year, you can claim, if you're eligible, up to a $5,000 credit against payroll taxes. Qualified wages are from March 12th, 2020 to the end of the year, December 31st. For this year, for quarters 1 and 2 of 2021, the benefit has gotten a lot better. It's 70% of up to $10,000 of qualified wages for each quarter. So that's up to $14,000 that you can claim in credits in 2022. The qualified wages for 2021. The qualified wages for 2021 are wages between January 1st and July 1st. Next slide. So who is credit? Who is eligible for the credit? You need to be an eligible employer. It's basically any private sector businesses or tax exempt organizations that carry on a trade or business that meets either one of the following requirements. This is an or test. It's not an and test. First, the first requirement is a business that was fully or partially suspended due to orders from the federal or state government, limiting commerce, travel, group meetings are due to COVID. The second option is a business that has experienced a significant decline in gross receipts during any quarter. That second option does not need to be because of COVID. So if you have a significant decline in gross receipts in a quarter, you don't have to show that it was because of COVID, whereas the first one is because of COVID. In addition, generally government agencies are not eligible for this, although the new act did expand it to allow for government hospitals and government universities to apply for it. If you're self-employed, you personally cannot get the credit, but if you have employees as part of your self-employment business, you can apply to the credit for those. One of the exceptions, though, is if you have household employees. Household employees are not eligible for this credit because it's not considered a trade or business to employ someone in your household. So the difference in the two rules for the years is in 2020, gross receipts had to decline by at least 50% of what they were in the same calendar quarter in 2019. In 2021, it's a easier test to meet. You only have to show that gross receipts declined by at least 20% of what they were in the same calendar quarter in 2019. 2021 does have an alternative test where instead of using quarter one in 2021, you can use the previous quarter. So you can say if your December 2020 quarter was down from your December 2019 quarter, then for the ERC in 2021, you can be eligible. And one of the big differences in being eligible based on fully or partially suspended are based on gross receipts test is if you're eligible for the credit because of significant decline in gross receipts, you're eligible for the entire quarter and possibly even the next quarter depending on your gross receipts. Whereas if you're eligible for the credit because of a fully or partially suspended operations due to a government order, you're only eligible for the credit at the time that fully or partially suspension exists. And we'll go into this a little more.
Can I ask a question?
Yeah.
Partially suspended. Obviously, I assume that's open for a lot of interpretation. But let's say I was out looking, this is true, I was looking at a car back in, I don't know, June or something, my wife, and it turns out you cannot test drive a car. It was not prohibited. I don't know, it's by insurance, or they couldn't go with me and they couldn't keep 6 feet apart or whatever it was, but they would not allow it. And I think that was across the board. Obviously, I didn't buy a car. I'm not going to buy a car that test driving it. Would they then fall into that partially? I would assume there's a lot of people like myself that's a big part of their business. I don't know what partially means. It 5%, 10% of your business operations? Is there any guidance at all?
Yeah, that's a great question, Rick. Can we forward to the next slide? Because there's some terms on there that I'll discuss. So for partially suspended, you have to have, the second bullet says you have to have more than a nominal position of its business operations are suspended by a governmental order. The IRS does have some facts and gives some examples of what this means. And one of the examples the IRS gave was for an auto dealership. The example it gave was if an auto dealership, at least in Massachusetts, was considered an essential business. That means they were not subject to the shutdowns because people need to get their cars repaired. But most auto dealerships have service on one side and sales on the other. And the IRS guidance says if more than a nominal portion of its business operations are suspended by the government order, then you are eligible for the credit. It's a facts and circumstances analysis, but the argument or the position would be that the sales portion of the dealership is subject to the partially suspension because they are no longer able to allow people to take test drives of automobiles. So during that period where that government order was in place, the argument would be that a significant portion of the company was subject to a government order to shut down. So they may be eligible for the credit.
Sounds like, Russell, that, because it's such a gray area, and there's probably, there may be some guidance, and I know, for example, you can, work from home, like in our situation, our people can work from home, and still get the work done. And I think we're specifically excluded as saying, because we can't have people in the office. But I would assume it's probably going to be necessary to sort of have, you guys or whomever document all the orders that were in effect, and then document, via emails or whatever it may be, how it affected your business. If you're going to claim this credit, and this credit, by the way, you're talking hundreds of thousands of dollars in some cases.
Yeah.
It's not small dollars, or more for that matter. So it is worth the time and effort to really make a case ahead of time, unless it's very obvious. If you meet the 50% test, that's fine. But on this one, particularly because my understanding is you only get the credit for the wages during that period. So it could only be 3 weeks that you're really affected by a government order. So you really want to make a case that you're affected for as long as possible, and therefore get as many wages into that ERC.
Right.
I don't know.
Yeah, no, it's a good point, Rick. What I've done over the last couple of weeks is just go through Massachusetts, all these Massachusetts orders. I think there's 60, although I think another one just came out that was effective yesterday. There's 61 orders in Massachusetts that just relate to COVID. And the orders talk about going into the phases, what phase you're in. Some of the orders are closing down like child care centers, but then 3 weeks later, they open them back up. Last March, April, and May seems like such a long time ago, and a lot of us have just blocked it out of memory. But the orders were just changing on a weekly basis because really no one understood what the virus was. So they weren't sure what types of orders would best protect the citizens. So what you need to really do is go through the orders to see which order was in effect. If your gross receipts are down by 50% last year or 20% this year, that's a lot easier test to get into. And a lot of these will overlap, like movie theaters. Movie theaters were basically, I think, closed until November. So they were under an order. They would meet that requirement. And also their gross receipts have plummeted. So since their gross receipts plummeted, that's a much easier test to meet. But there are a lot of gray areas. For instance, with restaurants. If restaurants that had indoor seating were under a lot of government partial and fully suspension orders. So a lot of them shifted to takeout. Some of the lucky restaurants, the takeout shifting was able to counteract the gross receipts decrease from the suspension orders, but they're still eligible because limiting the amount of activities indoor subject to a suspension order makes them eligible for the operations. And even now, when the restaurants were opened and they have limitations on where you can place the tables within each other, those types of rules should also make an entity eligible for a suspension or eligible for the credit under the suspension order.
But Russell, the key there is that for 2020, those same qualifying wages can't have been used to gain forgiveness under the PPP, whereas in 2021, you can attack both means. The other thing, go ahead.
Well, for 2020, both for 2020 and 2021, you cannot use the same wages for PPP.
Correct.
When in 2020, during 2020, you just couldn't use the ERC at all if you had a PPP. And then in December, this came out of the blue that they made it retroactive that, wait, yes, you can. So then it goes back to, well, what is the best method for the company to maximize both the PPP and the ERC credit. And that's where you start having to compare when you are eligible to take an ERC loan, how much you can take, and what period you're choosing for your PPP loan forgiveness. So that's
correct. The other piece of this that I think ties out to what you mentioned, Rick, is you almost have to attack the ERC eligibility like you are going to face an audit. So the way we're thinking about it, just like you guys would have audit defense, facts and circumstances, we're trying to suggest to our clients that you want to approach how you manage 2021 in particular as if you're going to be asked by the IRS to defend the position. So, I can't tell you that it would be a legal opinion because I don't think we'd be providing tax opinions per se, but if we cobbled together the various strains of facts and activity and tied those out to an executive order that did create this suspension, full or partial, that is a much better position for the taxpayer to enter and proceed than it would be to do it blindly. But that has to do with you and us together.
Yeah, if you're audited, if you just said to the agent, oh yeah, I was, partially suspended, and they say how, and I don't know, you have them skewed anything tangible versus here's a 5-page memo. Good luck. You're not going to challenge it. In my opinion, unlikely to challenge it unless it's blatantly wrong. But I think you would show that you did your due diligence. And I think that's critical with the type of dollars you're talking about. Now, if you're talking about a $15,000, $20,000 credit, and it's a gray area, but you believe you have it, you go with it. You take your chances. But if you're talking about, a couple $100,000 or more, you may want to document the reason for it.
Yeah. And one thing to note, just because you're under a suspension order, there are circumstances where you're still not eligible for the credit. For instance, my office is in Boston, and Boston is still, I think, under the 25% occupancy order. So that normally would qualify for being partially suspended. However, I don't need to be in the office. I haven't left my house in 9 months. So if the work can be performed regardless of the government order, then you are not eligible for the credit under the fully or partially suspended test. Some other items on this: impact on suppliers. If you're an essential business, you may still be eligible under the fully or partially suspended test if your suppliers are impacted in such a manner that it affects your business. And that's one of the other areas where you want to really look into the facts and circumstances and document all of that and talk to your advisors before it happens. Unfortunately, if the impact is on customers of an essential business, the IRS sort of says you're not eligible under this. And if we go back to the car dealership, even though the car repair part is an essential business, if there is a stay-at-home order in place and no one goes to the business, the IRS is, and at least in their facts, in their frequently asked questions, is taking the position that that does not make you eligible for the fully or partially suspended.
Russell?
Yes.
Just, we're approaching about an hour, so let's do it like another 10 or 15 minutes.
Okay.
I'll keep the thoughts and just time it accordingly.
Next slide. So this is basically what you need if you want to qualify under the government fully or partially suspension. You need a government order. Basically, I think we all know what that means now. Something from the governor, a major, the city's major, but it has to actually be in order. It can't be a recommendation, or it can't just be a news conference where someone says we think you should stay at home.
One thing on this slide, Russell, I just wanted to just bring up, it also says federal government or state or local government. And, we brought up the example where potentially something you might have to look at is, say you have a foreign supplier and they were subject to a foreign government, shutdown, foreign government order. You're going to have to consider whether or not there was something on the U.S. side. Maybe the port was shut down where that was coming in, but again, you gotta be careful on the selection there.
That's a good point. Okay, next slide. So this is one of the larger changes in the 2021 to 2020 credit. To calculate the credit, you base it on qualifying wages. For last year, if you had more than 100 employees, the credit is only available for compensation paid to employees who are not providing services. So basically, you have to be paying people wages to stay home if you had more than 100 employees. If you had less than 100 employees, then any compensation during the period when the company is eligible for the credit is taken into account in calculating the credit. Again, the time is from March 12th to December 31st for the 2020 credit. For the 2021 credit, they made this also better for employers. So they upped the limit to 500 employees. If a company has more than 500 employees, then they can only take the credit if the people are not providing services. So you're paying them to stay at home. Whereas if it's fewer than 500 employees, the credit is available for any wages that are paid to employees at that time. One thing,
quick clarification that came from the Q&A. Are these full-time equivalents, full-time employees, or just headcount?
no, the legislation uses it as full-time equivalents, which is defined as 30 hours per week, or I think it's 130 hours per month. So for the eligibility, it's full-time equivalent. For the actual credit, the legislation doesn't say it has to be full-time equivalents to actually claim the credit. It's actual employees. But to determine which category you're in, if you're over 500 or under 500, it's basically full-time equivalent.
Yeah, and just one thing I just want to touch on, and probably it's going to play too much, is even, when you're saying you're paying somebody to stay home, they could be in the office or in the restaurant, but you don't need them. So you have 6 servers to serve 2 tables.
Yeah.
In certain situations, we won't bore the details, but in that case, some of those people would still qualify as not providing services just because you have them show up and not do anything. So just keep that in mind, I guess.
Okay, next slide. So calculating the credit based on the qualifying wages. The wages may include both the employees and the employer's qualified health plan expenses that are properly allocated to wages. These are your typical cafeteria, 125, healthcare, the general health insurance plans that most people get from their employers. And as we spoke about earlier, a company cannot double dip. You can't get the benefit from the ERC and also use the same wages to count for forgiveness. What qualifying wages do not include severance wages or anything like severance. So you're generally really looking at the normal wages that you're paying employees. That's
another one on that one, Russell, isn't also the amounts you paid for health insurance for people who might be on furlough. Is let's say you had somebody on COBRA or whatever picking up. That's, for a lot of people that could be a big one. Just want to highlight that.
okay. Next slide. And so how to claim the credit, we spoke about this earlier. It's based on the Form 941, the payroll deposits. Again, you're taking it from the employer's share of the Social Security taxes due. Do not stop withholding from the employee's share if you're planning to take the credit. If it's more than the amount, you can offset it against other liabilities. You can file an amended tax return to get it. It's probably, as Rick was mentioning, you probably want to hold off on doing that unless you really need the cash, because we're hopeful that the IRS is going to come out with some more options for you to get at least the 2020 retroactive credit.
Russell, question. So when you're saying about so basically you wipe off the 6.2%.
Yeah.
And let's assume it's a, $300,000 credit. You've gone through that. You then eat into the withholdings from the employee withholdings.
Yeah, I believe that is the way it works as well.
And if it's above that, you get a refund. So basically, you're taking the withholdings that your employees get credit for, but they're trying to get it in your hands for liquidity is what they're doing.
Yeah, there's also a provision for an advanced payment for small employers, but it says subject to regulations that the IRS is yet to release. So we're still waiting to see what type of advanced payments they can get. Next slide. I think this is the last slide in the group. So this is basically a summary of the employee retention credit. It can really amount, depending on how many employees you have, you can get up to $19,000 per employee if you qualify. That $19,000 is based on $5,000 for the whole year 2020 and $7,000 for each for Q1 and Q2 of 2021. The easiest test to qualify, or the less stringent test to qualify for it, is, as we discussed, the percentage of revenue decline. Last year, the test was 50%. This year, it's only 20%. So it could be a really good credit for employers to get in order to fund additional cash flow to allow the company to operate for the next coming quarters.
You can easily be talking that if, company has 100 employees,
Yeah.
be talking, $1 million, $2 million potentially credits.
Yeah.
$1.5 million, whatever, if you qualify, obviously. All right. Adam, do we have any questions that are?
Yeah, we've got a few questions based on forgiveness. One of them is kind of just on the forgiveness of PPP loan 1. How does the treatment differ between part-time employees and full-time employees? I don't know if Rick wants to speak to that, or Russell, or.
What's the question again?
The question again, say that one more time.
The question in the chat is the treatment of if you have part-time employees versus full-time employees and their wages.
Oh, so
Is there a different treatment if you have a bunch of part-time employees hired back or working for you versus when you had full-time
I think
employees?
the issue that comes out, Tom, for growing here is you have to do the calculation of the FTE full-time equivalents.
Yes.
I don't think the wages makes a difference. You just got to meet that test or have an exemption if you don't meet that test. That's
Right.
the only way I see that coming into play.
Okay, and then there's a few questions about just delays with the SBA and stuff. What would you recommend for people who have submitted and have been waiting to hear back?
Have a drink.
Contact their lender.
I
We,
would say just wait. I mean, we've had stuff with the IRS for 8 months that have not been answered. They're just so backed up. And the SBA is true. I think they're starting to get cleared out now. So at this point, I would just sit and wait. There's no reason to pursue it.
I had a client send in 5 PPP forgiveness loans on the same day. Two of them were forgiven, and they were all roughly the same amount, somewhere between 100,000 and 600,000. 2 of them were forgiven in 60 days. 2 of them were forgiven, and it's going on 90 days now, and 1 of them's still outstanding. No rhyme or reason. All very similar types of organizations in the restaurant industry. Same support that was sent in. I think it all depends on who at the SBA and also the bank. You need to be careful. Some of the banks have the terminology some of the banks have been using to say when the application is finished is a little, I'll use the term gray area again. So there's been a lot of miscommunication about when
someone asked the question that they had to submit additional documentation. They had questions. I assume that resets their 90-day clock probably.
Yeah, the SBA language was actually said they had 90 days from when they considered the application complete. So if they take 80 days to look at the application and realize it's not complete, that probably does reset the clock. I'm also not really sure how hard and fast that 90-day clock is.
Yep. Tom, I think this one's for you. We spoke about it. The EIDL loan, the change in that and the forgiveness and how that kind of interplays with the PPP forgiveness, the recent change there.
Yeah, if you remember back when initially there was the concept of the initial PPP loan and the EIDL loan, there was a provision that carved out up to $10,000 of the initial EIDL loan to be treated as a grant. But then they basically said that initially they had to be looked at together. So in other words, if you had PPP and you had the EIDL, the $10,000 grant, they had to be looked at on the forgiveness side because you couldn't basically double dip on that money. And now they've gone back and effectively changed that. In some cases, people had, they've applied for forgiveness, or they've had forgiveness on one side and they've had it kicked back. So again, you're just going to have to work with your bank in order to work through those issues, because in some cases, people applied for those things before, applied for forgiveness on those things before there was actually a change in the law. And what we understand as well, Adam, correct me if I'm wrong, is that we heard that basically the SBA is going to return the money to the bank, and then it's kind of your responsibility to probably be in touch with the bank on that, because they're going to be, there's probably a little confusion there that you might help them clear up.
Yeah, I had a few clients where the SBA had remitted the additional funds to the direct lender, and the direct lender was working through their list, but the client reached out in advance of hearing from the bank, and then we're able to speed the process up. Russell, I have a question on affiliation rules and kind of how they differ between the ERC and PPP. Obviously, that's a highly technical area, but if you could give kind of the broad strokes.
Yeah, in general, the ERC rules are determined on an affiliate level. So if you're looking to see whether there is a reduction in gross receipts, you have to look at it at the affiliated group level. The same, so that may hurt you on the gross receipt test, but it may help you on the suspension test, because that's also on the affiliated group level. In addition, the 500 employee threshold, that's across all affiliate groups. So if you meet the affiliated group, you might be in a higher threshold than.
Again, Russell, in general, if you have that situation, you need to talk to counsel.
Right.
No,
Yeah, we got a lot of comments and questions and inquiries during PPP1 regarding affiliation. We anticipate we'll have that same line of inquiry, because we now have 2 paths to choose, and the affiliation rules are integral to both.
One thing to keep in mind is, I think we said this before, we have plenty of time. We don't have to rush to do this. So if we're still waiting for some guidance from employers, we have to, you have some time to, particularly even the first 2 quarters till another 6 months from now to figure out, and still go back to 2020. So we're not up against the gun now. We have to figure it out tomorrow. Obviously, if you need the money, that'd be different, but we have time to try to sort it out and see what kind of guidance comes out if it's a gray area.
Yeah.
Plus the SBA has been very good about getting guidance out in pretty fast order relative to some of the industry concerns that have been raised by industry groups and lobbies, or just things that make sense. You're talking to your accountant, to your lawyer, you say, well, what about this? And you're scratching your head. You sort of look beyond, you look and see what's out there. A lot of other people are scratching their head, and before you know it, the SBA is coming out with some new guidance on that very issue. So to your point, Rick, if you can afford to wait, which we can all afford to wait, it's a meaningful decision, because the IRS will likely answer that unknown area. And what we found, at least in round 1, is the guidance was pretty on point and somewhat liberalized to the advantage of the employer. So waiting is not a bad thing in this regard.
And the PPP2 loan application and the acts do talk about affiliate groups, and it's not entirely clear what it means. In one aspect, it says you look at the whole affiliated group to see the revenue as well for the PPP2 loans. But it also says if you have for this $150,000 test, but it also says you don't take into account any revenue between the affiliates. So if you have, say, a management company, and all that management company does is manage affiliated companies, it appears for the PPP2 loan that management company is going to have 0 revenue for the test, because you exclude all the affiliated group revenues. But the application itself, the checkbox and the entry points where you put in what your gross receipts are and what your employee counts are. It doesn't actually ask you for the affiliate. It appears to say applicant. So it is a little confusing with the affiliates. And as Jay said, that is probably one area where you may want to hold off and get counsel and really look into what all the available guidance is on it.
I think at this point, we're starting to see a few people that are dropping off, so we're probably reaching the end of the attendance span of a lot of people. So I think we have probably ended here. Obviously, if there's any questions, you can reach out to any one of us. We'd be happy to answer it offline. But I'd like to say thank you and thank all the panelists. That was very helpful.
Again, if you have specific questions, don't hesitate to reach out to any of us.
Yeah. All right.
Yeah.
Have a good day.
Thanks.
Nice.